You know how great your house looks and smells when it's just been cleaned? So fresh. And somehow, a clean house makes your head feel fresher too. With a housekeeper from Care, you can reset your house and your head as often as you like for less than you think. Find a great housekeeper, set a schedule that works for you, and check cleaning off your to-do list so you can put your mind to other, more fun things. Get the housekeeping help you need at Care.com.
Good evening. This is Mottek On Money, and we're doing it live right here weeknights in the 5 o'clock hour here in Los Angeles. Mottek On Money 5 nights a week for you, live on the air here on 790 KBC, streaming live online worldwide at KBC.com, and the on-demand Mottek On Money podcast for you at KBC.com, Apple, iTunes, all your favorite podcast platforms, and on the socials too at Frank Mottek on X, formerly known as Twitter and Instagram. Rough start to the month of August on Wall Street. Stocks ending lower today with the S&P 500 and NASDAQ seeing their fourth straight day of losses for the longest losing streak we've seen since early May. Investors taking in the latest jobs report. The big enchilada of monthly economic reports out today. The July jobs report out from the Department of Labor. We also saw the earnings parade continue from big names, including Amazon and Apple. The Dow coming in for a closing loss of 150 points. The S&P 500 down 24, and the NASDAQ gave back 50 points. For the week, the Dow down 1.1%, the S&P 500 slipping 2.3%, and the NASDAQ down 2.8%. On the jobs report, we see the economy added 187,000 jobs last month, with the nation's unemployment rate falling to 3.5% from 3.6% in June. The report showed average hourly earnings up 0.4% in July, up 4.4% over the past 12 months. Last month's wage growth was slightly higher than most analysts expected, while the number of jobs created was a bit softer than the 200,000 expected by Wall Street analysts. More fallout from that downgrade this week from the Fitch rating agency of Uncle Sam's credit rating, as well as the credit ratings of Fannie and Freddie, the two mortgage giants. We saw Treasury yields dropping after the jobs report. They had spiked earlier in the week. The yield in the 10-year note, which impacts fixed-rate mortgage rates, now at 4.06%, falling sharply. In fact, its biggest daily decline since early May. On the earnings front, we see Apple and Amazon in the spotlight. Amazon was among the best performers today, up 8.3%, while shares of Apple tumbled 4.8% to finish as the Dow's biggest loser of the day. Well, we have a new economic engine in town. In case you haven't noticed, Taylor Swift in town, packing in fans at SoFi Stadium in Inglewood. I'll discuss that from someone who was there on opening night of the Taylor Swift 6-night L.A. concert run, from someone who was there, none other than L.A. business leader Mark Wilbur. Yep, former chairman of the Los Angeles Business Federation, L.A. BizFed, chairman of Employers Group, and former associate dean of the USC Marshall School of Business. We'll talk about that, as well as the hot labor summer continuing with the writers and the producers. The Motion Picture Alliance supposedly talking today. What's come out of that discussion remains to be seen. In the meantime, the hotel workers are still on strike out there as well, and both the writers and the actors still on the picket lines here in Hollywood, which is completely shut down. We're also watching gas and oil prices, in case you haven't noticed. Eye-popping prices again at Southern California gas pumps as the price of oil has ticked higher after the state gas tax was raised recently. Governor Newsom now announcing the appointment this week of a new director with the State Energy Commission, whose job it is to monitor the oil industry. We'll get reaction to what's happening out there with Catherine REHEIS-BOYD, the president of the Western States Petroleum Association. But first, on the markets, the economy, the jobs report, maybe even Taylor Swift, too. Joining us live now, Jonathan HOENIG, Fox Business News contributor, portfolio manager at Capitalist Pig Hedge Fund, and author of the book Price is Primary, How to Profit with Any Asset in Any Market at Any Time. Looks like the market had a tough time shaking off the sell-off this week. Jonathan HOENIG, give us your reaction to what we have here.
Frank, great to be with you. I mean, could Taylor Swift turn Apple around? I mean, maybe only she might be the only one who could do it. And I think that's really what saw the sell-off today, Frank, in the market writ large, was that tremendous sell-off in Apple. I mean, even a 3% move down in Apple is such a gargantuan number. That's about $160 billion. That's the equivalent of the entire market cap of Disney. So it's as if the entire market cap of Disney lost today simply on Apple losing and breaking through a lot of those important trend lines. And, you know, Frank, as you've reported really for most of the year, it had been primarily the big tech stocks, those mega cap tech stocks, leading the way for most of the year. Now, the rally has broadened, But the fact that Apple fell so hard, so fast, I think has to give everyone a little bit of pause, especially since, as you also mentioned, interest rates look like they're breaking out once again.
Right. What about that Fitch downgrade of Uncle Sam's credit rating and the downgrade of the mortgage giants? People are wondering what's going on here.
Well, I think you have to be very careful when it comes to interest rates. You know, Frank, from 1971 to 1981, the return on Treasury bonds was about negative 27%. Think about that. You lost 27% after inflation holding U.S. government bonds during the 1970s. And, you know, we've got so many businesses, not just the banks now, but businesses still reeling from that, not only cost of higher interest rates, but the expense. You know, Frank, the federal government is now paying $1 trillion a year in interest expense on its debt. That's up 50% in just a year. So, you know, I fear these higher rates. I fear the tally-on effect on the economy. And I think when it comes to putting money to work, you've got to, as they say, keep your maturities very short because rates do, in fact, look like they're headed higher.
All right. And what will that mean to commercial real estate as well as residential, this downgrade of Fannie and Freddie? Will it impact businesses and consumers in some meaningful way?
Well, of course. I mean, Frank, you know, we talk a lot about stock market, of course, but you know, interest rates are really the most important number. Everything is based on interest rates, and they've been so abnormally low for so long. I mean, you know, short-term interest rates were under 0.1% just 3 years ago. Now they're knocking on the door of 5.5% in many cases. So, you know, this is a meaningful change. I don't think it's going away anytime soon. So, you know, I'm looking in terms of stocks at some of the oil names. You know, you mentioned they were really the star performers this week. ETFs like IEO or IXC or DBE, you know, that rising tide lifts all boats. I think oil in general and energy are names you can own right now. As we said, inflation doesn't look like it's being curtailed at all. And even some other commodities like orange juice and cocoa both hit all-time highs this week.
OJ back in the news. Orange juice, that is. Wow. That is really something. Now, let me ask you this. It was interesting to note in the Fed statement that we got about a week or so ago after they raised interest rates, they appear to have backed off their recession calls. And to follow up on that now, J.P. Morgan Chase today backing off its recession call, and Bank of America has withdrawn its recession forecast amid what they're seeing on the job front. Inflation still running hot, of course. What about where this economy goes from here?
Well, you know, the irony, Frank, is that, you know, we never got that official recession, but yet most Americans had been feeling and have been feeling a recession for, you know, well over a year. You know, the cost of the efficacy of our purchasing power, quality of lives have been going down for so long. And I think that's what's so frustrating. This is very similar to what we saw during the 1970s. There were some growth spurts. There were some periods of growth and comeback, even some pretty prominent rallies in the stock market during the 1970s. But that long-term trend was a slow degradation in the quality of life of every American, which is, I think, exactly this long-term impact that inflation continues to have. And one of the reasons I think you have to be very selective when it comes to your investments right now. I like energy, as you said. I also think you can buy some of the international and emerging market stocks, Frank. I mean, even something pretty broad like FM, that's Frontier Markets, FM. This is an ETF that just owns a broad basket of emerging market stocks, frontier stocks. I think they can do well, even if the U.S. economy continues to stall.
That's easy to remember. FM, Frank Mottek. There you go. That's easy for me to remember anyway. Let me ask you, I know you got some good ideas here, as always, for our audience. And what about the oil names? Let's hit on that again here with eye-popping gas prices here in Los Angeles, above $5 a gallon here on average. And you think this has more to run here?
It does, Frank. I mean, one of the nature of trends is that they tend to persist over time, oftentimes a lot longer than we would expect. I mean, you mentioned eye-popping gas prices. You remember a time, when $50 a barrel for oil, we used to say it was a ceiling. And then, of course, when that ceiling was breached, 50 became the floor. So it's very much about perception. But what we know about trends is that they do tend to persist. So as I said, these broad ETFs, IXC, FIL, FILL is another one. As the old saying, the rising tide lifts all boats. And I think energy writ large is going to be a strong area for the market. Keep it simple. Don't kind of get too fancy, I think, when it comes to this part of your portfolio. But prices continue to rise, energy in particular, and I think this is going to be a place where investors continue to make money.
Certainly tough time for consumers, but certainly investors have an eye on those oil prices. And then there's those ETFs with those cute names, right? Dust, I think, and Gush, is it?
Yes, exactly right. You know, as I said, Frank, just as when technology was raging, all the big cap tech stocks did well. I think you'll continue to see, and which is why you never want to make investing an all or none decision, you know, putting all of your money in tech or all of your money in oil. But the fact that oil stocks are doing well is a good indication that now, in my opinion, is a good time to have some of your portfolio in energy and oil writ large.
All right, we're getting this from the LA Times, a write-up here on what's happened here in Hollywood. Representatives of the Writers Guild of America and the major studios met today for the first time in 3 months, but there were no immediate signs of a breakthrough in the months-long labor standoff that has upended Hollywood. That's the very latest on what's happening here with this hot labor summer continuing, focused on Hollywood, certainly, with the writers and the actors on strike. Jonathan, I know you follow or at least watch the media stocks, which have been hammered. What about what's happening in that sector now?
Well, you know, you have to be agnostic when it comes to investing, Frank. I think, you know, you can't play favorites. You have to almost go where the action is more than anything, and not, as I said, again, have favorites. Ironically, the strongest media stocks right now, in fact, I think a real bull market, speculative bull market that investors can buy, it's not in streaming and it's not in, high tech or cable. It's in newspapers. Gannett stock, which is a newspaper company, GCI, Frank, it's up 50% in just the last 6 months. And some of these other newspaper stocks like Daily Journal, that's a DJCO, or Graham Holdings, that's the old Washington Post, GHC. These are all breaking out to new highs. Most of them are smaller cap stocks. Those are outperforming right now. So if I was going to buy any media stock, ironically, it would be newspapers, like some of those names I just mentioned. I think can be speculative buys even in today's market. That
is very interesting. Something was shared with me recently that we had somebody got an alert in Brentwood, one of those little crime alerts. It reported suspicious activity at 4 a.m, and everyone was wondering what is going on here. What was that suspicious activity? It turned out somebody was getting a newspaper delivered. That was the suspicious activity. So it's interesting that newspapers are rebounding on Wall Street. That is very, very interesting. And any other specific places here, Jonathan Hoenig, where you are putting money now and/or taking it off the table?
Yeah, I don't think you want to be fully invested right now. I mean, you want to have the options, Frank, especially considering short-term rates are rising. So don't be fully committed. But, you know, if you're looking for two, I think truly off-the-radar screen ideas, one are looking at the smallest of small names. You know, it's been the big names that have been outperforming this year, but what they call micro caps. These are the smallest of small names. Those, I believe, are set for a period of outperformance. F as in Frank, D as in David, M as in Mottek, FDM. That's an ETF that tracks the smallest of small names. And one more, again, with a pretty easy ticker to remember, is BOAT, B-O-A-T. This tracks a basket of shipping stocks, Frank. Now, it's volatile, but they also pay very hefty dividends, often in excess of 10 or even 15%. So if you can stomach the volatility, I think BOAT will pay some dividends over the long term.
Speaking of BOAT, we had the president of Princess Cruise Lines here recently, the guy who runs the Love Boat, of course. And what about...
You want to buy a car or a house, travel, retire? But it's getting harder to figure out what's the best way to spend and invest. Afford Anything is a podcast that teaches you how to be smart with your money.
Take the amount of money that you would make on that car payment, make that payment to yourself. That way, if you have to make a major repair, it can come out of that. And when you do go to buy your next car, who knows, maybe all 5 years worth of car payments have accumulated over that time.
Afford Anything, wherever you listen.
The cruise line stocks, which were getting a lot of attention because they had a tremendous run-up recently, and the airline stocks as people are traveling again these days.
Yeah, I mean, amazing, Frank. Carnival Cruise Line was a $5 stock last year. It's a $15 stock this year. So you got almost a 75% rise in just the last couple of months, just the last 1 year. Tremendous runs. I can't say I'd chase the moves just yet. I do think now, especially considering the skies are darkening, I think, on the economy, a lot of that revenge travel we saw post-pandemic, people saying, my God, I've been cooped up for 2 years. You know, a lot of that money's, I think, already been spent. So great move in a lot of the travel and airline stocks, the cruise line stocks, but I think I'd rather be putting my money in energy or emerging markets rather than chasing some of these big moves.
Very interesting. And you see any other flies in the Chardonnay here? What if any of the other ratings agencies start downgrading Uncle Sam or Fannie and Freddie? And what? And by the way, what did Fitch see that others haven't? And any other shoes to drop in the week ahead, you think?
Sure. I think just getting real. I mean, about the tremendous level of spending. And, Frank, your show is so often at the intersection of politics and economics. This is not a political issue. It's not red or a green, or red or blue. It's simply green. And both parties have been huge spenders in recent years. Fitch specifically cited a 15-year degradation in America's, sanctity of its checkbook. So this is a kind of a conundrum, if history is a guide, that it's going to take a few more years to get out. So, one that I'm looking at in terms of my investments is an ETF. It's PCY. Frank, this is an ETF that tracks not U.S. debt, but emerging market sovereign debt. So this is the kind of the government bonds of emerging market countries. If this is anything like that period of 2000 to 2010, there's going to be places to make money in emerging markets, even as the U.S. stalls.
Thanks for pointing that out. And certainly, we don't want any of our listeners to be bag holders. Any specific places where you'd be avoiding at this point or taking money off the table?
Well, start with your losing trades. People's biggest mistake, Frank, isn't that they pick a stock that goes down. We all do that. None of us are winners all the time, but they buy a stock, it goes down 10%, they buy more, it goes down another 10%, they buy more. The old saying is losers average losers. So I think a great place to start in your own portfolio is find those names that are already down 10 or 15, 25%, put that stop loss order in below the current market and resolve not to chase that losing performance. Focus on the winners, focus on the losers. The winners take care of themselves.
All right. And what about the world of crypto? Any observations about how crypto has performed this year and in the face of this week's events?
I've been surprised how strong it's held up. I mean, crypto almost seems now to be moving, Frank, as many of its proponents advocated over the years, as an alternative to the dollar. We've seen when the dollar tends to fall, crypto tends to rise. So it's kind of seems to be the appeal right now. And a lot of the crypto stocks, the crypto funds, were huge performers, even up in the last couple of months. So I wouldn't short crypto right now. And BITO, that's BITO, BITO is one ETF, if you're bullish on Bitcoin, that you could consider as a part of an overall portfolio. We don't own it at capitalspig.com, but I think if the dollar continues to weaken, crypto is likely to strengthen, regardless of what you happen to think of its practical appeal.
Great, Jonathan. Thank you very much for taking the call this evening. Hope to connect with you again very, very soon, and we'll be looking for you on the Fox Business Network and Fox News Channel. Thank you very much, Jonathan HOENIG, Fox Business contributor, portfolio manager at Capitalist Pig Hedge Fund, and author of the book Price is Primary, How to Profit with Any Asset in Any Market at Any Time. Great to have you with us, Jonathan. Have a great weekend, and thanks very much again for being with us here this evening.
Be well, Frank. Thank you so much.
Thank you very much. You're on 790 KBC. Friends, it's jarring to have a car accident and hard to think clearly when you're hit. So my friend attorney Clark Fielding of Fielding Law has created something to help you. It's a guide called Be Prepared Before a Motor Vehicle Accident. The guide is one page, fits right there in your glove compartment, and gives you everything you need in case you're hurt in an accident. Go to clarkthesharklaw.com and download your free one-page guide. Keep it right there in the glove box and put Clark Fielding's number in your phone under the word accident. So all you have to do is hit the number when you need them. Tell your family and friends to do the same. So if you're hurt in an accident, call the one we all trust, attorney Clark Fielding. The number is 833-88-SHARK, 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 and download the Be Prepared Before a Motor Vehicle Accident guide at clarkthesharklaw.com. Get that guide at clarkthesharklaw.com. Again, that's clarkthesharklaw.com. 790 KBC welcomes, you guessed it, Belinda Carlisle coming to the Libby Bowl August 24th. Tickets are on sale now at AXS.com. Right now, caller 9 wins at 1-888-790-5222. You can get a pair of tickets to the show if you're caller 9. There she is. Call now. Caller 9 wins 1-888-790-5222 for Belinda Carlisle coming to the Libby Bowl on August 24th. Mottek On Money continues here on 790 KBC. Rough week on Wall Street and a painful one on Main Street with gas prices moving up. Oil stocks had a big week. The Dow today coming in for a closing loss of 150 points, settling at 35,066. down for the third day in a row. The S&P 500 sliding 24 points to 4,478. The S&P 500 saw a fourth consecutive day of losses, and the NASDAQ slipped about 50.5 points to end at 13,902, also falling for the fourth day in a row. For the week, the Dow down 1.1%, the S&P 500 down 2.3%, and the NASDAQ down 2.8% for the week. The big enchilada, the monthly economic report's out today. The monthly jobs report from the Labor Department showing the economy added 187,000 jobs last month. The nation's unemployment rate did slip to 3.5% from 3.6%. The report also showed average hourly earnings up 0.4% in July, up 4.4% over the past 12 months. Last month's wage growth was slightly higher than expected, while the number of jobs created was a bit softer than the 200,000 expected by Wall Street analysts. On the earnings front, Apple in the spotlight. The shares down nearly 5% today after Apple reported a third straight quarter of declining sales. Amazon shares moving higher today by more than 8% after Amazon reported quarterly profit that beat expectations. Icahn Enterprises down 23% after the company says it's cutting its quarterly distribution to $1 from $2. And Tupperware Brands, which has kind of had a meme-like performance lately, soaring another 35.5% today after announcing a debt restructuring deal. And shares of Nikola down about 26% after that EV company beat Wall Street expectations for second quarter losses and revenue, but cut its full-year earnings outlook. Mottek On Money continues here in 790 KBC. Good evening. As you head out for the weekend, get a load of this. Most cars still cost more to charge than to fill up with gas. A big part of the electric car transition is cost parity with gas-powered vehicles. While charging and fueling trucks cost the same, other cars and their electric counterparts differ, according to a new study. It's not yet cheaper to charge some electric cars than to fuel them with gas, according to a new study out this week, as reported by Business Insider. That study by Anderson Economic Group compared the cost to fuel a gas-powered car with the cost to charge an electric one. In the meantime, we are seeing eye-popping gas prices again at Southern California pumps as the price of oil has ticked up recently. This after the state gas tax, by the way, was raised last month. Governor Newsom, meanwhile, has just announced the appointment this week of a new director within the State Energy Commission, whose job it is to monitor the oil industry and prices. Let's get a reaction tonight from Catherine REHEIS-BOYD, the president of the Western States Petroleum Association. Thank you very much for taking the call. First of all, on this electric car report showing point blank that most cars still cost more to charge than to fill up with gas. Give us your reaction to that report.
Well, I think, Frank, the more we get into looking at the details of the energy landscape, right, we're going to find that aspirational goals aren't necessarily a plan and they aren't necessarily reflective of reality in all cases. And so I think what we're seeing is, you know, that the electric vehicle transportation transformation is not going to be as cost effective as the aspirational goals had hoped, right? I mean, so what we're seeing is not a big difference in necessarily the benefits of a purely electric transportation system. And that is why we continue to push, Frank, for an all-of-the-above energy strategy. We cannot completely get off internal combustion engines, nor should we. It should be an all-of-the-above approach. And there's nothing wrong with hybrids, which combine electric and gasoline-powered vehicles. So I just think as we go through this energy transformation, we really need to look at the facts and the reality so that we put something in place that's realistic and that we don't have policies without capability.
On the air live with Catherine REHEIS-BOYD, the president of the Western States Petroleum Association. And, of course, as we've discussed in the past, Sacramento's answer to high gas prices is raising taxes. And we saw that again last month, right, as the gas tax popped up, another 4 or 5 cents. And now prices are, on average, again, above $5 for regular here. And now this new setup there in Sacramento with a new director within the State Energy Commission whose job is to monitor the oil industry. This is coming out of the windfall profits tax idea that came up late last year. Give us your reaction to what's happening there now in Sacramento.
Yes, and the appointment, as you know, for this new division within the Energy Commission certainly came out of that bill you referenced. Of course, we're going to look to develop a collaborative relationship, but what I hope really comes from this is that we begin to be able to provide information on how the market works, right? Understand how the energy flows in California occur, understand the energy realities, understand we're an energy island. We don't have pipelines that bring crude oil here, that we can't get permits to drill for crude oil in California, and so you have to import into congested, ports in California. And so every gallon of gas is already $1.26 more than anywhere else in the United States because of the policies put in place and the taxes that you referenced. So I'm hoping, really, Frank, that through this process, we can have a real conversation about the energy realities and the costs associated with them, and really look at how do you put something together that has all of these options and makes it more affordable to have reliable fuel to the consumers and the communities that we serve every single day.
With Sacramento now getting involved in all of this, in the Soviet-style kind of a price situation here, can we expect even higher prices now?
Well, no one can predict prices, but I'll tell you this. We have the mandate that we can't sell any more internal combustion engines in 2035, which has very unrealistic assumptions. The charging stations aren't close to meeting the needs. We have 2 new regulations for a zero-emission truck mandate and a zero-emission fleet mandate. And what does that mean? It increases the cost to truckers, to consumers, to public services, to transit buses, to trash pickups, and it limits options for consumers to make their own choices. And if we go down the path of replacing all natural gas appliances and furnaces to electric, we're going to have more costly, for every lawnmower, for every generator, it's just cost. And so I really think we need to look at the fact that we would have to have a tripling of today's electric power infrastructure to do all of this, and we don't. And so I'm hoping that this new appointment and this commission will sit down and look at the realities of how do you get from A to B so that we can do it affordably and reliably. Because the path we're on now, I see a series of cliffs and hard landings and not a smooth transition.
We've always heard that it's supply and demand that determines the price, but certainly these policies are impacting supply here in California. Obviously, for decades, we've been hearing we need another refinery built, but looks like that's never going to happen, right?
There is never going to be another refinery built in the state because all of the signals to the refiners currently in the state are that there is no policies that are going to support their continued existence. So you can imagine a business who is in the business of supplying gasoline, diesel, aviation fuel, natural gas to the consumers are being told that they'll be phased out completely over time. Not a great incentive to continue to invest in infrastructure and make sure that we have reliable fuel. So, we're going to do the best with what we've got, but we're losing 2 refineries in the Bay Area who are converting to renewable diesel, so no gasoline will come out of those refineries. So in the northern part, of course, that means there'll be tight supply. And what happens when there's tight supply? There's increased cost. This is not rocket science. This is the market. So we have to figure out what is the right formula that's going to allow us to go from A to B, not saying these goals aren't meritorious in some fashion from a climate change perspective, but Frank, let's get it right. There's too much at stake not to.
Absolutely. And let me ask you this. It's been said that California is an island when it comes to gas and oil, but an actual island, Hawaii, in the middle of the Pacific Ocean, we're paying more for gas than they are at the moment.
Yeah, you're exactly right. And that goes right back to the policies and the things that we decide are important, but yet we don't take the time to figure out what is the most logical, affordable way to get there. And again, I still believe it is an all of the above energy strategy. I do not believe diversification is a bad thing. I think it's a good thing, just like we do in our portfolios for our stocks and our pension plans and our 401ks, right? Nobody puts their eggs in one basket. So we should design a plan that doesn't do that. that takes advantage of every technology. EVs, certainly. Electric vehicles are certainly one of those technologies, but they are not the only one. And you cannot electrify the entire state of California without repercussions.
And isn't that something? And 100 years ago, California accounted for 25% of global oil production. How did we get to this point here?
Because we are not able to drill for oil in California. We have not had a new drilling permit in California since January, which means instead of the prediction of crude oil going down slightly in California, we are going down right now 9 to 10%. That is huge. If you don't have crude oil being produced in the state of California, as you've said, Frank, it's coming from imports from faraway places that don't have our environmental standards, that are putting more emissions in the atmosphere, and to get it to California takes time and money. Why would we be doing this?
Excellent question. We'll have to follow up on that with you next time. And we, of course, look forward to our next conversation. Thank you very much for enlightening us on what's really happening here in California. Catherine REHEIS-BOYD, the president of the Western States Petroleum Association, joining us live here tonight on Mottek On Money on 790 KBC. Folks, is your knee pain keep getting worse? How about that pain in your shoulder, hip, or back? Don't let them tell you steroids and surgery are your only options. Take my advice now and call QC Kinetics. It's Frank Mottek here. QC Kinetics can make that pain go away with all natural, advanced, regenerative medicine. They're helping people here every day with these amazing natural treatments that restore and repair that damaged joint tissue. It's like turning back the clock. Regenerative medicine uses concentrated healing agents from your very own body to stimulate that damaged tissue in your joints so they work like they're supposed to, and there's zero downtime. QC Kinetics is the nation's leader in this exciting medical breakthrough. Patients here are getting real lasting relief and are saying no to surgery and drugs. If you have pain due to injury or arthritis, this is a remarkable option that you need to check out, and the consultation is absolutely free. Call QC Kinetics, locations now in Glendale, the city of Orange, Mission Viejo, and now also in Costa Mesa. The number to call is 213-997-PAIN. 213-997-PAIN. Again, that's 213-997-PAIN. Mottek On Money continues here in 790 KBC. There's a new economic engine in town in Los Angeles. Her name is Taylor Swift, packing in fans at SoFi Stadium in Inglewood. That's happening, and we have the hot labor summer continuing as well. Let us bring in now the one and only Mark Wilbur, former chairman of the Los Angeles Business Federation, LA BizFed, chairman of Employers Group, and former associate dean of the USC Marshall School of Business. And I've been reliably informed that Mark Wilbur attended opening night, the Taylor Swift concert last night at SoFi Stadium. So, Mark, thank you very much for being with us. I didn't see any earthquakes registering last night, but it must have been quite an event. Tell us what you saw there last night.
It was quite an event, Frank, and thanks so much for having me on. You know, it's a real machine. If you look at the economic impact that tour has had, it has to be the largest in history. I know there's been a lot of comments about that, but it's really stunning. It's a fantastic show. I don't know if you saw the really special moment. Kobe Bryant's daughter, Bianca, was there with her mom, and Bianca actually had a moment with Taylor Swift at the end of the stage, and it was really, really a precious moment.
That's beautiful, and certainly very, very touching, and what a night for everybody, and it's going to continue for another 5 nights here.
Yeah, and I got to tell you, if you haven't gone, there are tickets online that you can find. Via the reselling sites, that are out there. And, you can even, sit with some obstructed views that aren't too crazy of pricing. But it's an expensive event. But I got to tell you, she plays for nearly 4 hours, just 3 hours and 40 minutes based on my gauge on my watch. And it was nonstop. The staging, the effects are jaw-dropping. I mean, it really does set a new bar for performance standards of a real show. And she's very theatrical. She really likes to change costumes and change the whole scene and the light-up thing with the wristbands. I mean, it's absolutely unbelievable, Frank. I mean, it's one thing to see a big show, but this felt like way more than that. So if you haven't seen it, I'd get out there and try and see if you can find yourself a ticket.
Well, we're going to have to get the calculator out to figure out the exact economic impact of all that, but it's got to be substantial. And in the meantime, the writers and the And the producers did talk today. We understand nothing's come of it from what we see initially reported. Of course, the writers out there with the actors for the first time since 1960 with the picket lines pretty big today in certain locations, especially in the Valley today. So give us an update on how you see this whole situation playing out.
It's interesting, Frank, because, the economics in that industry has shifted so dramatically over the last decade that I don't think a lot of the actors and the writers understand this to a certain extent. I understand wanting more money. I understand wanting to get a pay increase. I get all those things, and I think everybody does. But at the end of the day, when your valuation and your revenue streams have been completely flipped upside down, through streaming. I mean, a lot of these companies, you look at Disney, a vast majority of its valuation comes from streaming. You look at the impact of market changers like Netflix and all those activities of streaming, it impacts the amount of revenue. It kind of reminds me of the days we all threw away our CDs and started listening to streaming music as well. It took a while to get that sorted out. I think it is sorted out now, but it took a long time, if you think about it, to get that sorted out. TV is now being impacted. You and I, Frank, could go start a streaming business tomorrow. I mean, there's not a lot of barriers to entry in this industries, other than the huge market maker brand companies, like the Disneys out there. And it's having a huge impact on this debate because they don't understand the economics for which they are protesting and picketing for. And so they need to, instead of just picketing, they ought to try and figure out how best they could play in this new world, just like the musicians did. Gosh, Frank, that's got to be 15 years ago or more.
Right. We're not going to go back to the days where CDs were delivered by mail. That was just about 10 years ago. That's hard to believe, which is what Netflix was doing back then. And we got the jobs report today, and looks like some of the major banks have throttled back on their recession calls. Give us the real here on what people are talking about on the Los Angeles economy here among the movers and shakers you interact with there at the Los Angeles Business Federation.
It's a huge impact. We're going to start seeing, all kinds of debt just drying up, the availability of capital and investment and those kinds of activities. And when that stuff starts happening, it just starts grinding the economy to a halt. And so, we have talked about this in the past. We have a one-trick pony right now. All we do is increase the interest rates. There's no other activity going. It's almost as if Washington is cheering for the failure of our economy. It's kind of hard to fathom that. But when all you're doing is damaging the overall economy by just continued interest increases and not looking at the residual impact of that, nor how the economy actually fits together on the global landscape of things, it's really going to start having a dramatic impact. That's why this recession talk is getting more serious by the minute.
Certainly. And of course, then you have Sacramento also with its policies impacting businesses here. And it looks like there's more of a population decline, people voting with their feet here in California.
There was the California Department of Finance just came out with some projections. Some of the news stations are reporting on it. So, they showed that Los Angeles is going to have a 1.4 million decrease in population of people moving away in the next 30 years. And I was like, wow, I think 2060 was actually the date in which they gave, so it's a little bit more than 30 years. But nonetheless, you start thinking about the impact of that when tax rates that they set are based on population, right? So those projections go in. So if they're going to predict a declining population, is the strategy here to then use it as an excuse to continue to ramp up tax rates, which is going to drive even more people away. So it'll be interesting to see what the update is on this projection about a year from now.
Well, thanks for mentioning that, and we'll keep an eye on that. And Mark Wilbur will let you continue your recovery from that big show last night, and that must have been really something. It ended around midnight, was it?
Yeah, it ended around midnight, and I swear, Frank, can we not get parking figured out? it took me almost as long to get out of the parking lot as it did to see the show.
Wow.
It was an hour and 40 minutes to get out of there. It was crazy. They got to figure that out.
That is really something. Well, Mark, thank you very much. Have a great weekend and look forward to speaking with you again very, very soon. That is Mark Wilbur, the former chairman of the Los Angeles Business Federation, LA BizFed, chairman of Employers Group, and former associate dean of the USC Marshall School of Business. Live with us here this evening on Mottek On Money on 790 KBC. We'll be back again Monday evening in the 5 o'clock hour. You can also bring up the Mottek On Money podcast on demand at kbc.com, Apple iTunes, and all your favorite podcast platforms. Stay tuned now for the 790 KBC News Blitz. Royal Oaks talking legal matters with you. Coming up next, right here on 790 KBC.